Discounted cash flow techniques. Investment appraisal is a critical component of management accounting that enables organizations to evaluate the financial viability of long-term capital expenditure projects. Since capital investments often require substantial initial expenditure while generating benefits over many future years, managers must assess whether expected returns justify the resources committed. Modern investment appraisal techniques are based on the time value of money, recognizing that cash received today is worth more than an equivalent amount received in the future because of its earning potential. Consequently, management accountants focus on cash flows rather than accounting profits and employ discounted cash flow methods such as net present value (NPV) and internal rate of return (IRR) to support strategic investment decisions. Cash flow versus profit. An essential distinction exists between cash flow and profit. Profit is an accounting measure calculated by matching revenues with expenses in accordance with accrual accounting principles. It includes numerous non-cash items, such as depreciation, amortization, provisions, and accrued expenses that affect reported earnings without involving actual cash movements. In contrast, cash flow represents the actual movement of money into and out of the organization. Cash inflows arise from customer receipts, asset disposals, and financing activities, while cash outflows include purchases, wages, taxation, and capital expenditure. Investment appraisal focuses on cash flows rather than profits because investment decisions ultimately depend on the organization's ability to generate future cash returns. Depreciation, for example, reduces accounting profit but does not involve cash expenditure and therefore has no direct impact on investment viability. Consequently, discounted cash flow techniques evaluate projects using expected cash inflows and outflows rather than reported accounting profits. Relevant cash flows. Only relevant cash flows should be included when evaluating investment projects. Relevant cash flows are future, incremental, and cash-based. Future cash flows occur after the investment decision and will arise only if the project proceeds. Incremental cash flows represent additional receipts or payments directly attributable to the project and exclude existing business activities unaffected by the investment. Relevant cash inflows may include increased sales revenue, operating cost savings, disposal proceeds from existing assets, government grants, and residual values at project termination. Relevant outflows include acquisition costs, installation expenses, working capital requirements, maintenance costs, training expenditure, and additional operating costs. By contrast, sunk costs, representing expenditures already incurred, are irrelevant because they cannot be recovered regardless of future decisions. Similarly, non-cash expenses, such as depreciation, are excluded, while financing costs are generally reflected through the discount rate rather than individual cash flow estimates. Net present value (NPV). The net present value (NPV) method is regarded as one of the most theoretically sound investment appraisal techniques because it directly measures the increase in shareholder wealth generated by an investment. NPV is calculated by discounting all expected future cash inflows and outflows to their present values using the organization's required rate of return, where CF_T equals cash flow in period T, R equals discount rate, I_0 equals initial investment. A positive NPV indicates that discounted cash inflows exceed initial investment costs, and the project should be accepted because it creates value. A negative NPV indicates value destruction, and the project should be rejected. Where alternative projects are mutually exclusive, the investment with the highest positive NPV is generally preferred. Internal rate of return (IRR). The internal rate of return (IRR) represents the discount rate at which the project's NPV equals 0. NPV equals 0. IRR therefore measures the project's expected annual percentage return. The investment decision rule is straightforward. Accept the project if IRR exceeds the required rate of return cost to capital. Reject the project if IRR is lower than the required rate of return. IRR provides managers with an intuitive percentage measure of project profitability and facilitates comparison between investment opportunities of different sizes. However, projects with unconventional cash flow patterns may generate multiple IRRs, making NPV generally superior for complex investment decisions. Present value of annuities and perpetuities. Many investment projects generate equal annual cash flows over several years. Such constant periodic cash flows are known as annuities. The present value of an annuity is calculated as where C equals annual cash flow, R equals discount rate, N equals number of years. This formula simplifies valuation by avoiding separate discounting of each annual cash flow. Where cash flows continue indefinitely, the investment becomes a perpetuity. Its present value is. Perpetuity valuation is commonly applied to preferred shares, perpetual bonds, and certain long-term infrastructure or property investments. Payback period. The payback period measures the time required for cumulative cash inflows to recover the initial investment cost. The basic calculation is where annual inflows are constant. The discounted payback period applies present value techniques by discounting future cash inflows before determining the recovery period, thereby incorporating the time value of money. Payback is simple to calculate and emphasizes liquidity and investment risk by favoring projects with rapid capital recovery. However, it ignores cash flows occurring after payback and, in its traditional form, disregards the time value of money. Interpretation of investment appraisal results. Investment appraisal techniques provide complementary perspectives on project viability. NPV directly measures shareholder wealth creation and is generally regarded as the preferred decision criterion. Projects with positive NPVs increase organizational value and should normally be accepted. IRR provides a percentage return measure that is easily understood by management. Projects with IRRs exceeding the organization's cost of capital are financially acceptable, although IRR may occasionally conflict with NPV when comparing mutually exclusive projects. The payback period measures investment liquidity and risk exposure by identifying how rapidly invested funds are recovered. Shorter payback periods generally indicate lower financial risk and greater flexibility, although profitability beyond payback is ignored. In practice, organizations frequently employ all three techniques simultaneously. NPV provides a primary measure of value creation. IRR facilitates performance comparison through percentage returns, and payback highlights liquidity and risk considerations. Together, these discounted cash flow techniques provide a comprehensive framework for evaluating capital investment projects and supporting long-term strategic decision-making in management accounting.